The My Free Taxes Self-Employed Guide, Tax Preparation for Home-Based Childcare Businesses, sponsored by My Free Taxes and the United Way. The information contained here has been prepared by Civitas Strategies Early Start and is not intended to constitute legal, tax, or financial advice. The Civitas Strategies Early Start team has used reasonable efforts in collecting, preparing, and providing this information, but does not guarantee its accuracy, completeness, adequacy, or currency. The publication and distribution of this information is not intended to create, and receipt does not constitute an attorney-client or any other advisory relationship. Reproduction of this information is expressly prohibited. Welcome to the My Free Taxes Self-Employed Tax Guide for Home-Based Childcare Businesses. In today's video, we will discuss key tips that will allow you to self-prepare your sole proprietor business taxes. We have a two-part guide that we've developed to help you self-prepare your business taxes. The first part is getting ready for tax time. This gives an overview of basic tax concepts and business practices that will help strengthen your business now and into the future. It also includes helpful worksheets that you can use. Part 2 is filing your return online. Through My Free Taxes, you can file your federal and state return online free of charge. To help you complete the business portion of your return more easily, this part walks you through self-preparing your Schedule C step by step using the free online software available through My Free Taxes, including helpful screenshots and explanations. United Way created this guide to help more self-employed business owners easily and accurately file their taxes for free. Designed for both full-time and part-time entrepreneurs, this guide takes you through the steps of getting ready to self-prepare your taxes using online software. In this short video, we will talk through the use of the guides and highlight key tax topics for your business type so that you can self-prepare with confidence. Those topics are reducing your audit risk, understanding your Schedule C, calculating your business use of home and vehicle, and resources to help you with your taxes. Small businesses play a critical role in our economy, generating income and wealth that supports the financial needs of entrepreneurs, employees, and their families. However, the costs and stress associated with filing business-related taxes limit the positive financial impacts of self-employment for many entrepreneurs. Taxes are an important consideration for any business. Through taxes, we all contribute to our government at the national, state, and local levels. As a business owner, they are a cost that reduces your profit. While you should always heed IRS regulations, you will likely want to reduce any costs to your business, including taxes. Effective tax preparation can head off the long-term costs of an audit. Though only a relatively few people are audited every year, if you are audited, the cost in time and money can be great. The best way to avoid an audit is to keep in mind common red flags, that is, the issues that often lead to an audit. The most common red flags for home-based childcare providers are not including all your income on your taxes, such as leaving out a 1099 that you received from the Child Care Resource and Referral Agency for subsidized care. Taking off too many expenses or ones that are really high, like a provider who claimed $40,000 in cell phone expenses for themselves each year. Taking a very large loss on your business or having losses year after year. Businesses will take a loss from time to time, but you want to avoid having losses that are far in excess of what you've earned. After all, your business regularly loses more money than it earns. The IRS may be curious about why you continue to operate it. Claiming 100% use of your vehicle. Some of you may have a van or car you use for transportation for your business. That is allowed. However, reporting that the vehicle is only used for work and never for personal reasons can draw attention since it is less common. As you can see, many of the red flags can be easily avoided through proper preparation of your taxes. Let's take a closer look at the Schedule C to view the different sections for reporting data on your business. If you use tax software, it will enter these numbers based on your answers to certain questions, but it can still be helpful to know your way around this important document. Part 1 is where your sales are totaled and your cost of goods sold is reported so you can see your gross profit. Part 2 is where your business expenses are reported. There are over a dozen categories listed to help you stay organized, such as advertising, car and truck expenses, legal and professional services, rent, travel and meal expenses, and other costs. The last section is where your net profit is calculated, which is line 31. It is calculated by subtracting your total expenses from Part 2 from the total revenue in Part 1. Your net profit is considered your income from self-employment. The first section of your taxes is all about revenue. That is, how much money you made. Getting this information may be easy if you have an accounting system. If not, no worries. You can use the revenue worksheet provided in the guide to calculate it. Start by gathering your records. You are likely to have 3 types of records for revenue. 1099 forms. These are evidence that another business paid you for services. Many home-based childcare businesses will receive a 1099 NEC, that is a 1099 NEC, for the subsidy care payments and for participation in the Child and Adult Care Food Program. You will also receive a 1099 if you received more than $600 in business payments from apps like Square, Zelle, or PayPal. Next are your bank records. These show additional funds you may have received from other sources. And your own documents, such as year-end or weekly receipts. that show parents paid for care. Then fill out the revenue worksheets. Include each 1099 and revenue for each child you serve. Also, list other income, such as grants, that may not already be accounted for on a 1099. If you received reimbursement for food costs through the Child and Adult Care Food Program, you can report all the reimbursements under the income section of Part 1 of the Schedule C using the 1099 you received. You can then deduct your food expenses in full in the expense section. Now that you have your business income, you need to collect your expenses, i.e., what you spent money on for your business in 2022. You want to make sure you have records of your costs, ideally receipts showing payment for expenses, but you can also, in most cases, use canceled checks, invoices, or credit card and bank records. It is critical that any proof of an expense show that you paid the expense, the amount you paid, the date you paid it, and a description of the item purchased or service received. The one exception is mileage deduction for your vehicle. In this case, you should have a simple log with the date, the distance you went, where you went, the purpose, business or personal, and as specific as possible. The mileage log included as a resource in the guide is a simple log you can use to fill in your vehicle use information. To collect your expenses, begin by collecting all your receipts. Next, go month by month in your records for 2022 to review your credit card bills, check app-based system payments such as Venmo, Zelle, PayPal, and Square Cash, and look at your bank statements and checks. With your accumulated expenses, you can now fill out the expense worksheet included in the guide. The worksheet uses the expense categories for a Schedule C that are the most relevant to home-based childcare providers, but they can also be used for any corporate or partnership tax return as well. The full amount of home expenses that are directly related to your business can be included in your expenses in the expense worksheet. The IRS defines a direct expense as one that is incurred exclusively for the business and provide no personal benefit. Some examples of direct expenses in your home are fixing a bathroom used only by the children, getting a new children's rug for the play area, and purchasing playground equipment. Indirect costs associated with your home, such as homeowners insurance or your electric costs, will be covered in the business use of home section. You should hold on to all proof of payment through the tax season and at least 4 years after. It's great to have paper copies as well as electronic ones, even if that is just you snapping a picture of each with your phone. Including the cost of your home. How do you include the cost of your home? As a home-based childcare provider, if you are licensed or registered with your state and regularly use your home in your business, you can deduct the cost of your home and other related expenses. To prepare for claiming these deductions on your return, whether you rent or own your home, there are 2 steps you need to take. First, determine the space and time used for childcare. And 2, determine the allowable expenses related to providing care in your home. Let's look first at calculating the space and time use of your home for business purposes. How does the time-space calculation work? there are 5 key steps. The first step is you will determine the square footage of the area in your home that you regularly use for your childcare space. Next, you'll divide the square footage of that space by the square footage of your home to determine a percentage. Next, you'll determine the amount of time your home was used for childcare during the year. Then, you will divide the hours your home was used for childcare by the total hours in a year. Last, you'll multiply the percentage of the space used in your home by the percentage of time your home is used for business to determine what percent of your in-home expenses are for your business. We'll go through the calculation briefly in this video, but we include a spreadsheet and worksheet for you in the guide to make it even easier. Typically, space is measured in the square feet of your home that is used for care and the total square footage of your home. A key concept to accurately measuring business use of your home is exclusive versus regular use. Home-based childcare is the only business in America that can have 2 different types of business use. Exclusive use is space that is only used for childcare and has no personal use. Regular use space includes areas that may be used all day for care, such as a play area, but it also includes ones that are regularly used for only part of the day. To give an idea of an area that is only used part of the day, the IRS Guide to Auditing Childcare Providers uses the example of a provider with 3 children who each nap in different rooms at quiet time so they can rest better. Though the other rooms are just used at nap time, it is regular use and can be included in your calculation. As a rule of thumb, regular use means you use the space 2 or more times per week. The first step of calculating time space is to determine the square footage of the area in the home that is regularly used for childcare. Here is that term I've mentioned before, regular use. Consider all the spaces that get used regularly for childcare. Regular use means it's used for the business at least once a week, and children do not have to be in those areas for it to be counted as regular use. For example, storage rooms, laundry, a desk that you use for an office all count. To calculate square footage, you will first need to measure the length and width of your space. More on determining the square footage of the area in your home that you regularly use for your childcare space. You may already know the square footage of spaces in your home, but if not, there is a simple way that you can measure it. Using a tape measure, you'll fix a tape measure to one end of the longest wall in your space and extend it to the other end. You'll record this measurement in feet, not inches. Next, fix a tape measure to one end of the shortest wall in your space and extend it to the other end, and you'll record this measurement in feet. This is what that calculation looks like. Multiply the length by the width of each area regularly used for childcare. For each of those regularly used spaces, add the square footages together for an overall total for your childcare program. For the next step, you will divide the childcare square footage you just calculated and divide it by the total square footage of the home. This gives you a percentage of the home regularly used for business. For example, if you use 500 square feet of your home for childcare and the home is 1,100 square feet, then the result is 0.454. You'll multiply that number by 100 to get the percentage, which is 45.4%. So now you have the space part of your time space, and these next steps get you the time component as well. The third step asks for the total amount of time the home was used for childcare during the year. In addition to the time children are present, that's from the first drop-off to the last pickup, the provider should also include the time spent doing things for the business when children aren't there, including cleaning, activity prep, meal prep, talking to parents on the phone, interviews, time researching things online, etc. Providers will use the hours the childcare is open per week and multiply that by the number of weeks open for service and include the hours performed while closed. For example, if your business is open 10 hours per day for childcare, but you spend an hour beforehand preparing and an hour after cleaning up, that's 12 hours per day, 5 days per week. Let's say you closed for 2 weeks due to the pandemic, but during that time, you spent 10 hours maintaining the child care space and preparing for reopening. Now let's do the math. That is 12 hours per day multiplied by 5 days per week, multiplied by 48 weeks open, plus the 10 hours when you were closed. That's a total of 2,890 hours for the year. Now for step 4, you'll divide the hours the home was used for childcare by the total number of hours in a year. In our example, we'd divide the 2,890 hours we just calculated by 8,760, which is the total number of hours in a year, which will get us 0.329. We'll multiply that by 100 to get the percentage 32.9%. Last is step 5, where the base percentages, time, and space get multiplied for the combined percentage. In our example, those two multiplied together equals 0.149 or 14.9%. This 14.9% represents your time-space percentage. It is the calculation of the time and space your home is used for childcare business purposes. You may also have space that is exclusively used for childcare. Those spaces that are exclusively used for childcare will only be subject to the space calculation, not multiplied by the time percentage. It's important to remember that you need to be able to show space that is exclusive versus regular use if asked by the IRS. This should be evident by how you have set up the space. Remember, exclusively used space means you have no personal use for the space at all. Another important step in including the cost of your home on your taxes is to collect allowable expenses. The full amount of expenses that are for your home and directly related to your business can go under your expenses under the applicable Schedule C line. Now we want to focus on collecting indirect expenses related to your home, such as electricity usage, which is partially for your business, but also partially for your own use. We will use the time-space percentage to calculate how much of the indirect expense to include as a business cost. This list includes many of the indirect home-based business expenses you can collect by looking at your receipts, bank accounts, credit card bills, checks, invoices, and app pay services like Zelle and Venmo. All are subject to your time-space percentage. Those are rent, mortgage interest and mortgage insurance payments, but not principal, real estate property taxes, electricity, gas and oil, water, sewer, and other utilities, home telephone, internet and cable, cleaning and lawn care services, and homeowners or renters insurance. Make sure you have records of your indirect expenses for your home, just like you would for all your other business expenses. Home costs can be fully or partially deductible. If it's a cost for an exclusive area, it's likely entirely deductible. In regularly used areas, you need to use your time-space calculation to determine how much can be deducted. Fully deductible expenses include exclusive use area costs and direct costs related to your child care business. For example, replacing the tile in a basement used only for childcare, installing a child-sized toilet, liability insurance. Partially deductible expenses include regularly used area costs, common area improvements. For example, replacing all the windows in your home, repaving your driveway, your homeowner's insurance. Those would be subject to your time-space calculation. Understanding depreciation. Depreciation is a special method the IRS uses for deducting big expenses, which are considered assets, which are those over $2,500. This can be an expensive piece of equipment or the depreciation on the costs of your home or vehicle if you use them for business. Sometimes you may have to deduct these expenses over years, even if you paid it all in 1 year. This can sometimes surprise business owners who were anticipating deducting the cost in full. The number of years that you will deduct the item depends on what its useful life is. The IRS has helpful charts with useful life values for you to follow. Most tax softwares also calculates this for you. There are 3 special rules for depreciation that can help you deduct your depreciation faster. There is Section 179 depreciation, which allows you to deduct in full the cost of tangible personal property such as office equipment, furniture, vehicles, and most other assets that are not buildings or improvements to your building, including a home used for business. There is one catch, however. The item needs to be used for your business 50% or more of the time. The second special rule is known as bonus depreciation, which allows you to deduct 100% of certain assets in 1 year without an upper limit on the total amount you can deduct. To qualify for bonus depreciation, the item needs to have a useful life of 20 years or less, so it does not apply to your home, and it must be used for business 50% or more of the time. There are separate rules for vehicles, however. For vehicles under 6,000 pounds, you can expense $19,200. For vehicles over 6,000 pounds, but less than 14,000 pounds, They do not have a limit. Just like Section 179 depreciation, you need to use the vehicle at least 50% of the time based on the total miles driven, and the amount of depreciation must be adjusted by the business use. Bonus depreciation will continue to be 100% through the end of 2022. In the following tax years, the percentage of depreciation allowed will decrease, starting in 2023, when you will be limited to 80% of value until it ends completely in December 2026. The third special rule is known as Safe Harbor for Small Taxpayers. This rule comes out of the IRS Tangible Property Regulations and allows you to deduct repairs or improvements to your business location that is the lesser of $10,000 or 2% of the unadjusted basis. That is the value of the property less the value of the land. For example, let's say you had a business that was worth $350,000 and the land is worth $50,000. The unadjusted basis would be $300,000. 2% of the unadjusted basis would be $6,000. So, an improvement like adding an awning that was $5,500 could be deducted in 1 year. With all three of these rules, it is important to note that state limitations can vary, so depreciation, as I just described, may only apply to your federal tax return. If using tax software, it will guide you through these decisions. Let's run through it step by step. Your software will do this, but it can help to know how it works so you aren't surprised. First, is the expense over $2,500? If yes, it is considered an asset which is subject to depreciation. Next, is it a repair? A repair can't add value, so it needs to be of similar function and materials. If it is a repair, it would not be subject to depreciation, but deducted as a repair and maintenance expense. Third, is this equipment or a land improvement? Equipment is broadly defined, so it can include a lot of things. Generally, an improvement extends the usable life or adds value to the property. Improvements must be depreciated. Fourth, if it is a facility improvement, is the total cost under $10,000? If so, there is a special rule for small taxpayers where you can still depreciate it all in 1 year. Fifth, there are other scenarios that may dictate whether an asset will need to be depreciated or if there are accelerated depreciation rules allowed for it. You should always consult guidance from your tax software, IRS guidelines, or even a tax professional if you are not certain. Many providers may use their own car or truck in the course of their business. This could be transportation services for children or driving to meetings or to run errands for your business. Vehicle costs can add up, so keeping records of costs and knowing how to deduct them is important. These are the elements you need to make sure your transportation is deductible. It must be in the regular course of business and separate personal and business, and be child or business related. Transportation costs can be deducted as they relate to the regular course of business, Some typical expenses relate to taking children to and from school, field trips, medical facilities, and trips to buy business-related supplies, and etc. Trips can be for personal and business. It is deductible if the primary purpose of the trip is business. Example 1. You go to Costco to get a long list of supplies for your childcare. While you are there, you pick up a jar of pickles for yourself. That is deductible. Example 2. You are at the supermarket getting groceries for the week. You remember you also need a box of wipes for your childcare business, so you get them while you are there. That is not deductible. There are two ways to deduct your vehicle expenses. The standard mileage rate provides a simple cost per mile that is used to calculate your deduction. The actual expense method uses all the costs of your car. If using the standard mileage rate, use the provided mileage log in the guide to keep track of the information needed for your mileage deduction. If you use your car a lot for your work, you may want to use the actual expense method. It requires more record keeping, but could result in a larger deduction. With the actual expense method, you will collect receipts or other proof of payment for all the expenses related to your car. These can include a variety of expenses. A worksheet is included in the guide that can help you collect the total amounts. There are pros and cons to this method. A pro is that it includes all the costs for your vehicle, from gas and tires to lease payments or depreciation. A con is that greater scrutiny and recording burden is placed upon you. Alternatively, you can use a simple IRS mileage rate. You will keep track of your miles, day, and purpose on a simple log or use an app. Unless you're using your vehicle very heavily for your business, the mileage method is usually easy and fair. Pros is that it is much easier to account for and less scrutiny of the deduction is involved. A con is that you are bound to the mileage rate, which for 2022 was 58.5 cents from January 1st through June 30th and increased to 62.5 cents per mile for July 1st through December 31st of 2022. There are other resources included in the guide. This includes a tax rubric, which helps you assess your past taxes and learn how you can improve your filing. There's understanding payroll taxes for businesses with employees. There's quarterly estimated payments, understanding what these are and whether you need to make them or not. Opening a business bank account, which discusses the importance of a business bank account and how to go about opening one. There's creating a simple financial system, in which every successful business needs a financial system. It doesn't have to be elaborate, but one that you use and helps you keep track of your revenue and expenses. And there's understanding depreciation, which gives a more in-depth look at this sometimes complex but useful tax deduction. There are additional business tax and business resources. You can call 211 or visit 211.org to get connected to additional resources and services that can help you, your family, and your business. There's America's SBDC. Small business owners and aspiring entrepreneurs can go to their local SBDCs for free face-to-face business consulting and at-cost training on a variety of topics. There are nearly 1,000 local centers available to provide no-cost business consulting and low-cost training to new and existing businesses. Learn more about filing your return online in part 2 of this video. Thank you.